Good day, everyone, and welcome to the third session of the MEDA and Standard Bank webinar series. My name is Tobile Finga. I am the Program Manager of the African Women Impact Fund at Standard Bank. The African Women Impact Fund is a project that seeks to develop and invest in African women fund managers across the continent. As such, I'm excited to be the moderator of part 3 of our impact-focused webinar series that is centered on understanding the unique value of African investments and women as key decision makers. In our first webinar that took place in March, we focused on understanding the African investment landscape and the impact of women in driving the continent's economic growth. In the second session that followed in June, we gained insights into African investment strategies from women fund managers driving change in local markets. Now, in today's session titled Leveraging Risk Mitigation Strategies for Africa-Focused Funds, we take our conversation a step further. In our discussion today, we will be delving into the important role of risk mitigation strategies in transforming investment ideas into the mobilization of capital into Africa. This webinar will highlight innovative risk mitigation tools such as first loss capital, credit guarantees that help to mitigate risk and boost investor confidence. Through real-world case studies, today's panel will explore how these tools can lead to substantial investment commitments. The panel will also share actionable steps that institutional investors can take when looking to mobilize capital into the continent. I am now pleased to introduce today's phenomenal women who will be joining me today to share their insights, starting with Paula Felipe, who is the Upstream Advisory Manager for the FIG Industry Department for Eastern and Southern Africa at the International Finance Corporation. Paula is a senior executive with extensive experience in emerging markets, particularly in Asia and Africa. Since 2023, Paula has been leading IFC's efforts to enable investment opportunities, enhance investment outcomes, and improve investment conditions in these sub-regions. She leads a team of technical experts, project managers to implement investment-linked capacity building services with regulators and private sector clients. These are on priority thematic areas aligned with IFC's Africa strategy. We also have Dia Martin, who is a managing director in the Office of Catalytic Investments at the U.S. International Development Finance Corporation. In her role, Dia originates debt financing across multiple emerging markets. She also leads the Portfolio for Impact and Innovation program, which is focused on financing scalable earlier stage projects that are highly developmental. Through this program, DFC has provided over $500 million in financing to over 80 innovative businesses and funds that are committed to having a positive social impact. We also have today Jenna Diallo, Regional Director for Investments at Prosper Africa. Jenna has more than 20 years of experience in international development with a focus on private sector development and facilitating access to finance and investment in emerging markets. Jenna brings with her a world of knowledge from different markets, having worked for USAID in Pakistan, the Philippines, Senegal, and Uganda. Now, before we get started, I just want to remind everyone who has joined us today that we will leave time for a Q&A session at the end. If you do have a question on the topic or for any of our panelists, you are welcome to type this in the chat. I will now kick off the session, and I will start by asking each of our panelists to tell us more about your organization, the role it plays in the market, and in your response, if you could also touch on what your organization's view on the topic of real versus perceived risk in relation to investments in Africa. Maybe, Jenna, if you could just kick us off.
Sure. Good afternoon, good morning to everyone. So Prosper Africa is a presidential national security initiative to catalyze and scale two-way trade and investment between the United States and Africa. To scale investment, we are mobilizing new U.S. investor classes, such as pension funds, ultra-high net worth individuals, venture capitalists, endowments, foundations, and insurance companies to make large-scale investments. We facilitate transactions at scale. We develop market-based risk mitigation tools to solve market failures, and we deploy grant funding strategically to build better investment ecosystems. There's definitely a delta between the real risk and the risk perceived by U.S. investors when it comes to Africa. We have seen through organizing delegations of investors to the continent the difference that it makes in their knowledge and understanding of the opportunities. One of our key goals is to increase awareness in the U.S. of those opportunities. Last year, we organized 4 delegations to the continent, and we continue to work with investors and their consultants on understanding the market and the risk mitigation strategies available in partnership with the U.S. government.
Thank you, Jenna. Dia, perhaps if I can hand over to you.
Sure, and thank you so much for having me on this panel today. The DFC is the US's development finance institution. We have a portfolio of over 40 billion, and approximately 25% of our portfolio is in sub-Saharan Africa. Our mandate is to serve as a catalyst for private sector investment across all of our countries of operation. With this in mind, we are very clear on the understanding of what is perceived versus real risk. And our goal as an investor is to properly assess risk, the real risk, to assess and mitigate it through structuring or offering different vehicles for investment. In regards to the perceived risk, we're very interested in serving as a bridge for investors that might have a perception of risk that is not in line with what the market or what our experience as a DFI has informed us. So we do that as a bridge through communication, investing first, and then investing alongside private investors, as well as participating in a number of different organizations and collaborations to address those issues from investors. Another part of DFC is really being thoughtful about how we take on strategic risk. So we have been organized in a way that my department, the Office of Catalytic Investments, looks at being a first mover and catalyzing additional investment. With this area, we are seeking to be forward-leaning in our view of risk and take on more risk where we see ourselves as being able to build markets, to support nascent sectors, as well as to serve vulnerable or underserved populations. So I'm excited about this conversation today and talking about all the ways that DFC can work with investors, potential clients, and the broader market.
Thank you, Dia. I think being first movers is very important when it comes to proof of concept. Paula?
Yes. No, thank you very much. I'm very happy to join this discussion. So the IFC, International Finance Corp, is a member of the World Bank Group. It's a AAA rated corporation owned by 186 countries. And we provide investment, project development, advisory, and private capital mobilization to support emerging markets. So essentially, our mission is to build a private sector in emerging markets. Our aim is to create jobs, raise living standards, and build a better future in the markets where we operate. We are the largest global DFI focused on the private sector. And I think it'll be good to demonstrate that by citing some figures which illustrate particularly IFC's commitment to Africa. So in terms of our commitments in FY23, $43 billion, 23% went to Africa, $70 billion portfolio, 21% is in Africa. And our advisory expenditures of $260 million last year, 38% of that went to Africa. Okay. Last year alone, we recorded the highest investments that IFC has ever achieved in Africa across our key industries, the financial sector, manufacturing, agri and services, and infrastructure, recording $14.2 billion worth of commitments. So I think in a way that kind of takes me to my discussion on real and perceived risk, because our commitment demonstrates that we are ready.
Mm.
Our commitment to, participate in the African financial sector is very clear and very similar to what what Jen and Leah mentioned. The main thing about risk is really understanding it, being able to articulate it, measuring it, and finding instruments and ways to mitigate it. Our intervention to be able to achieve that is composed of our work with public and private sector actors, building capacity, and then providing the right solutions, both in terms of investment and advisory, to be able to clarify the risk and lead other private sector investors to participate in the market. Many ways with IFC leading the investment. And I'll be happy to talk more about examples later on. Yeah, thank you.
Thank you for that, Paula. And the example is exactly what we're going to be discussing next, bringing our discussion to a bit of a more practical level. And I would like to do that by asking each of our panelists to give us some examples of these risk mitigation tools that you have implemented in your organization. And maybe hand it back to you, Jenna.
Sure. So a couple of examples that we have from Prosper. Last year, alongside USAID, we helped a West African mortgage provider to structure and issue a 275 million DFC guaranteed bond with US institutional investor participation. This created a liquid, de-risked investment vehicle suitable for US institutional investment. And the transaction unlocked affordable housing for more than 6,000 low to middle income households that will then lead to significant economic multipliers. So there we were able to use some of our grant funding and our ability to convene and structure a transaction that was also done in collaboration with DFC's guarantee tool. In another example, Prosper Africa and other USG agencies provided $10 million to establish the first creditor guarantor, the Green Guarantee Company, dedicated to climate solutions in developing markets. The support catalyzed commitments from the Nigerian Sovereign Wealth Fund, the Bank of Japan, and others for the initial $100 million balance sheet. And this initial $100 million is set to unlock over $1 billion in green financing. So here it's again using grant funding, but in a different way in order to help kind of convene and catalyze other donors and investors, but also to help seed that initial balance sheet to get it going. And then in addition, we've provided grant funding directly to fund managers, both private equity and venture capital. And those managers have used the funds to help them fundraise in various ways. So some use it as first loss capital to attract investors, others use it as technical assistance, and yet others to cover operational costs while raising investment.
Thank you, Jenna. Dia?
Thank you. I'd like to first talk about the scope of DFC's work and then narrow it down to a few key examples. And I'd like to use first talking about the tools that we have. So at DFC, we have the full toolkit for investment. We have equity, debt, guarantees, and technical assistance. We have a relatively sizable investment funds department that has made a lot of investments, both debt and equity, into funds and into several regionally focused funds. Also, outside of the funds department, we've had a lot of support for debt funds as well as direct investment in transactions. I think some of the things that would be most interesting is some of our work, we've had a fund that was focused on SMEs across sub-Saharan Africa, where we were able to enter into an investment with a direct loan to the fund, as well as providing a guarantee to kind of offset potential losses for investors. Another example I'm thinking of is a fund that was focused on education. This was a first-time female fund manager, where it's very interesting. We moved from tools to actually structure of investment. And we were able to structure this investment to fit the economics of the transaction. What that meant is offering a longer tenor, offering a structured interest rate to provide some room in the first few years for flexibility as the fund was building up scale, as well as a component of profit sharing so that we can win in the awards or the success of the fund, but not tax the fund in a very harsh way as they're growing and they're reaching that peak performance. So I think I really want to highlight those as clear examples where we're able to come in with the various DFC tools, whether it's debt, equity, or technical assistance, but also within those tools, we're able to use flexibility and structure to meet the economics of the projects.
Over to you, Paula.
Yeah, thank you. So what I'd like to highlight is basically, I'd like to highlight our 30 by 30 project in South Africa, which showcases how we help mitigate risk through technical assistance. This is one of our flagship projects in addressing the impact of climate change in key markets which are most vulnerable. And the idea is to incentivize banks to increase their climate finance portfolios by 30% by the year 2030. How we went about it is engaging both at the public sector level, with industry associations, and also at individual bank interventions and engagements. So in South Africa, we worked with the Bankers Association of South Africa, with the Johannesburg Stock Exchange, or the National Treasury, to deploy advisory services and build awareness and capacity in the areas of sustainable finance and climate risk management for both FIs and the regulators. And what this has led to over the time since we started this, which was 2019, is to build up a portfolio of 10 loans and bonds totaling about $1.6 billion up to FY24. And it's really scaled up our ability to finance the green building agenda in South Africa, promote renewable energy, which has really been instrumental in addressing the power crisis in the country, which has really affected the lower income population. In addition to that, still in line with the climate agenda, we work with the two leading banks in Tanzania to help them issue their maiden green bonds. So both CRDB and NMB were the lead investor. We catalyzed the investment from other private sector players, bringing in $20 million to the CRDB green bond, which was 400% subscribed. And alongside the investment was again capacity building to help them understand how to deploy the green assets and how they should go about reporting and monitoring their portfolios going forward. And then lastly, I'd like to provide a quick example on how our risk share facility works. And the unique thing about IFC's risk share, because we're a triple A rated institution, is that in many jurisdictions, it's considered as zero risk weighted by the regulator, which thus helps open up the balance sheet of banks to finance further these underserved segments. So we worked with Orange Bank to provide a risk share facility of $15 million for them to finance small businesses who were on the Orange Money platform. And through the risk share, the bank was able to gain confidence in providing financing to this segment. At the same time, we were also providing capacity building to Orange Bank to be able to set the framework to sustainably finance this underserved segment, which is a new thing to the bank. And I'll stop there. Thank you.
Thank you, Paula. You mentioned the energy sector and a bit on green bonds. Can you expand on what some of the sectors, these structures, where you see them being most impactful?
So in general, I think sectors where the market needs to build better readiness or being able to be comfortable from a risk perspective to go in. I think that's where we can best play a role as a catalytic investor and as a provider of technical expertise, both on a market level and at firm level. So what are these key sectors which we see to be, where we can really leverage on the tools for risk mitigation. I've already talked about climate, so green finance, and then also one of the key achievements in South Africa was also to enable the first blue finance transaction through one of the larger banks there. So being able to understand the climate space and how banks can assess the risk of investments in the different aspects of climate finance. The second piece where I think this could be quite useful is in the agri space. We had just recently launched our Agri Accelerator program, and in many countries, we see the need to support attaining food security by allowing banks the ability to finance agri smallholder farmers through leveraging on the capabilities provided by agtechs, to provide visibility and operational efficiency for FIs to services sector. And alongside that, we can provide risk mitigation instruments like a risk share facility to make the banks more comfortable in taking on this new segment. And lastly, it's in the broader inclusion space on digital lending, similar to what we did in Orange Bank, where through our risk mitigation tools, we are able to get banks to explore expanding their portfolios to new segments, which are not conventionally banked, where, for instance, you rely on the digital footprint to be able to assess risk and looking at risk management in general in a more innovative way that leverages on technology and digitization.
Thank you for that. I think this highlights the importance of having an institution that understands markets and has powerful market research. The next question is for you, Dia and Jenna. You've mentioned fund managers and risk structures that you've worked alongside governments as well. Can you tell us more about how you go about in working and collaborating with others outside of your organization and implementing some of these solutions? Dia, I'll perhaps start with you.
Sure. I think this is a really important point. I think for some of our most effective catalytic transactions and being able to really come into the market and make a difference and empower different groups, it's very important for us to have partners, because while we have a broad spectrum of products, we also need the support of partners to help us as far as building out the capital stack. So I'll first start with individual partners, and then I'll talk about collective organizations that we've worked with. So obviously, and as Jenna's on this call, one of our clear partners is Prosper Africa, and some of the transactions she mentioned, we work quite closely with USAID throughout the continent, working on different transactions together and bringing different types of services to our clients to the table. We've also partnered a lot with different foundations across the continent. So for example, we've really built out our e-mobility practice working with the Shell Foundation and then made some really exciting investments in East Africa. The fund that I mentioned before, we partnered with UBS Optimus Foundation, and we've partnered with them in a number of different funds where we've looked at using that blended finance tool for investment. I think we also partner with other investors, specifically on the impact side, and providing that continuum of financing directly to clients. So we'll often look to work with very engaged early stage equity investors in the social impact space, and also work as well with debt providers that we can co-invest together, or often work with them to provide perhaps a longer tenor financing product. As I move on to organizations or larger collectives where we've partnered, we've worked very closely with the ARIA initiative, and this initiative specifically focuses on fragile and lower income countries in sub-Saharan Africa. And this is a collective DFI initiative that includes BII, FMO, and PRARCO, and we've worked with them. We're also a very active member of 2X Global, And I think this organization is extremely important for women fund managers, specifically across the continent. There are a lot of developments that have happened over the past 12 months that are very useful, and I think are going to be very transformative in getting that much needed capital to those women-led fund managers, and also fund managers that are focused on women as investees or as clients or end users. And then I also like to talk about some of the initiatives that we've worked to develop alongside USAID and others. One that's notable is our Merck for Mothers initiative that we started in 2019. And in this initiative, we worked with USAID, Merck for Mothers, as well as Credit Suisse. And this initiative was very important. It was more focused on direct investment to companies, but focused on really delivering a stack of capital, grants, debt, technical assistance as well to those companies focused on maternal health. So to sum it up, we look forward to collaborating with others, whether it's individual co-investors or foundations, as well as participating in groups that are really being thoughtful and strategic about how they allocate their different sources of capital for investment and development.
Amazing. Jaina?
Thanks. Yeah, I mean, I would echo first, the first thing that Dia said, or the kind of main theme that Dia was talking about, was that in any given transaction, especially when you're talking about, sectors that need support and risk mitigation, there needs to be multiple players because you need all of the various tools, right? There's not kind of a single tool that will suffice. So you do need, the financial tool. You are likely going to need, some sort of grant mechanism. So, partnering is a very natural thing to do. Because you are going to need multiple tools, for the capital stack and to get the thing done. But also it helps, with risk sharing among partners. So, we regularly engage with all sorts of investment ecosystem stakeholders, local pension funds, other donors, multilateral institutions, and others, to try to, group solve, the problem for any given investment solution. And so the example I gave earlier about the Green Guarantee Company, I think, is a really good example of how we collaborated with USG agencies, also with international donors and financial institutions to launch what is now going to be a sustainable credit guarantor organization. For us, partnering can take a lot of different forms. I mean, we can, partner and spend our funds side by side with other organizations. We partner in ways to explore innovation as well. We use contracts and grants to spur innovation in risk mitigation and ecosystem building as well. And we do a lot of convening of stakeholders in order to pool expertise and resources.
Thank you, Jaina. Now, the importance of these risk mitigation tools lies in the outcome and the impact that you seek to make. Paula, you mentioned, obviously, you do quite a lot in the climate and green bond space, and those are typically linked with KPIs. What are some of the measurable outcomes that you have experienced in the implementation of these tools and structures?
Yes, thanks very much. So before I respond to that, I just want to highlight in IFC, whether we do a new investment transaction or we do an advisory engagement, we are going to be measured by outcomes. So we set out these indicators and they're publicly disclosed in terms of what we intend to achieve in those projects. So you're asking about climate. Very key in our climate projects is being able to measure the reduction on GHG emissions resulting from the climate finance that we'll be able to facilitate. And IFC has technical tools that allow for credible measurement of those results. So that's one example. If I take 30 by 30, aside from this measurement, we're also measured on the amount of investment that we're able to catalyze through this program, either through loans or through the capital markets. And that's, again, something which we have to achieve from the beginning. And broadening, like more broadly, like if we talk about the other aspects that we work on. For inclusion, for instance, we have to be able to measure, reach numbers, percentage of populations covered, the number and value of loans outstanding and disbursed. So these are very, very concrete demonstrations of the results of what we have invested both in terms of our financial resources and the technical resources that we have. And maybe I'll just highlight the results that we did, that we were able to from the new investments. These are the numbers that we anticipate to achieve once these projects are concluded. So 2.2 million in new loans to MSMEs, $24 billion in outstanding MSE loans, nearly 500,000 farmers reached, 2.2 to 3.1 million in new jobs created, and 11.5 million in greenhouse gas emissions reduced. Okay, so just to give you an idea of the holistic numbers that IFC is looking to achieve through the last investment commitments it's made.
Thank you, Paula. Real tangible figures. Jenna?
Thank you. Yeah, I was going to focus on the results we've achieved so far with the support that we gave to our funds. Prosper Africa has partnered with 9 African asset fund managers under the Prosper Africa Catalytic Investment Facility. And together, the 9 funds will mobilize more than 600 million in private capital to fuel African innovation and entrepreneurship. And to date, the funds have raised nearly 78 million in capital, with 46% private capital and 37% from US investors, to invest in critical sectors such as climate, health, technology, women's empowerment, and education. And also in partnership with Prosper Future Africa, one of those 9 partners launched a pre-accelerator in June of this year that supported 26 high-impact startups with over 700,000 in direct investment, and has positioned them to raise further funding and gain acceptance into global accelerator programs.
Over to you, Dia.
Thank you. So I'd like to frame it in a couple different ways, thinking more broadly about the outcomes, and then talking about specific tools that we have and how they help to generate those outcomes or secure those outcomes. So for every transaction that we invest in, whether it's a large project finance, it's a fund, or it's an earlier stage company, we look at the developmental impact. So we measure our outcomes by long-term developmental impact. Echoing Paulo's remarks, we want to mobilize additional capital. And so it's very important for us to measure the capital we crowd in at the time of our investment, but also long-term over time. Another key thing that we look at, which is really important, is additionality. We are in the market to serve a market gap. So we want to ensure that our financing is coming in to meet critical needs that are not currently being served by the private sector. So we really see ourselves as a bridge. To that end, some of the things we look at are our projects that will have a demonstration effect. A great example is we have invested in development impact bonds or outcomes-based financing. We started with that with an investment looking at specifically investing in a healthcare project in Cameroon, but we've been able to build on that demonstration effect to look at investing into a $100 million bond, the SDGs Outcomes Fund, that is focused on investments globally, with a significant portion of its investments focused on Africa, specifically to date in Nigeria and Kenya. So we want to see that demonstration effect of our projects, our investments, that they're used to spur other investment. And obviously the scaling is also an important part of that, to be able to either support funds that are able to scale portfolio companies, or support fund managers that could go on and raise future funds for investment. And I think specifically when you talk about our tools and how that leads to outcomes, we look at that technical assistance as structuring or pre-investment TA to support better outcomes, but we also have post-investment TA to support the ongoing performance of that fund manager or that company to also generate stronger outcomes. When we looked at debt financing, as I mentioned, we're a bridge to provide outcomes for scaling and private investment, and similarly with equity. So we have that holistic view of, in general, what the outcomes are that we look for with each project. But then we also specifically use our tools to kind of steer or support those outcomes coming to fruition.
Thank you, Dina. Certainly crowding in other investors and boosting investor confidence is a key outcome of these risk mitigation tools. Now, taking a look into the future, as markets evolve, you require tools that are relevant to the risks that they are targeting. What are some of the learnings and ways in which your organization is considering improving the risk mitigation tools and exploring innovative approaches? Gina, you did mention that within your partnerships, innovation is something that you take into consideration. So perhaps we can start with you.
Sure. Yeah, we're really still ourselves kind of continuing to look at, what else we can be doing in innovative ways to mitigate risk. We're really looking for ways to support the ecosystem and working with partners to explore innovative approaches. So, for example, just this past year, we've been putting out more contracts with partners so that we can do that kind of exploration of innovative approaches to risk mitigation. So we have a contract with Cross Boundary right now focused on increasing investment in Francophone Africa. We also just recently put out a request for proposals focused on the VC and early stage investing ecosystem in Africa. In fact, next week we have a learning event with one of our contractors to review performance, brainstorm new approaches. One of the issues that we've seen that is making it challenging for investors and consultants to analyze opportunities and is driving the risk up is the lack of available data and performance data on the continent. And so that's something that we're looking at and exploring partnerships around. We've also been talking to funds about shared services models to decrease their cost of operations. A lot of emerging fund managers are looking for ways to sustain their operations while fundraising. Organizations are setting up warehousing facilities to support emerging fund managers. So these are some of the things that we're continuing to explore as we look at how to increase, the way we can support mobilizing investment.
Thank you, Jenna. I think the lack of data is a huge reason for the perceived versus real risk perception that we face on the continent. Paula, maybe if you could shed some light on what's in the future for IFC.
Yeah, so very interesting question. I think to the point in data and how it helps demystify the risk, right? To those who want to participate more in investment. And I think to this end, it's really a challenge and an opportunity for us in IFC to leverage what we can do with advances in digitization. Because that is what's going to be able to give us an ability to overcome, limitations in terms of brick and mortar structures and the conventional ways of understanding risk so that we can do it more efficiently. And maybe allow me to cite some examples of how we're doing this and how, the direction we're taking in terms of leveraging data. In our work on credit infrastructure, we're starting to support moving away from conventional tracking of credit history and looking at how alternative data generated from payment transactions, mobile money transactions, how the accumulated data can be a basis for now creating a credit history as a proxy to what would be in conventional cases, a banking footprint. When they don't have that, use alternative data to be able to create a credit profile for individuals and have that built into the credit information system. So there's work that we're doing in South Africa and Kenya along advancing those lines, and a few pilots being done by credit bureaus to really test it so that we know whether it works and how to scale it up. And also what I mentioned in AgTechs, how do you, going further away from conventional support to agri-farms and using the ability of technology to give visibility to farms which are difficult to reach through conventional bank structures, being able to monitor productivity and cultivation, even if you don't have boots on the ground. I mean, how do you use data in order to make banks understand how the risk is evolving until the time to monetize the agri production? So I think in short, there are many ways where we can fill the data gap by really understanding how we can leverage technology to serve as a provider of information that will give us clarity on risks which used to be opaque to us. Yeah. And finally, just maybe another, like maybe more of a lesson, is really that there's nothing that replaces boots on the ground. And I think that's one unique thing about IFC, where, with our nearly 200 manpower covering financial sector across the continent, we're really able to engage directly and understand these risks. And through that, have a very clear understanding, which we can then share with a broader range of investors to participate in these key areas for development.
Thank you, Paula. I think boots on the ground speaks also to the importance of partnerships. Dia?
So my quick answer to the question is the fact that I'm sitting in the office of Catalytic Investments today is one of the ways that we are trying to very thoughtfully capture learnings to improve outcomes and to mitigate risk. This department was newly created at the beginning of this year, and it was created so that DFC could be strategic and thoughtful, and its approach to being forward-leaning and impact and outcomes in the markets that we serve. So we actually work very closely with all of the different sectors at DFC to target specific markets that we feel should be focused, that might be nascent or that might be smaller, and to develop those markets. We're also set up to be very thoughtful about how we approach innovation. So it's not perhaps innovation for innovation's sake, but innovation to actually come up with a new financial product type of investment or support a new area for growth and real impact. So that's part of how we hope to glean our lessons learned. And along with investment, we also have a part or a vertical within our department where we really want to track data and information, agreeing completely with Jenna and Paula on that point, and be very thoughtful about what the lessons are learned from that data so that we can leverage those for future transactions. Another part of what we want to do is be very thoughtful about partnerships and platforms. And we feel by being thoughtful and focusing on that, we can continue to be catalytic, mitigate risk, but do it in a very efficient manner. And look at structures that work and try to replicate them more easily with the right set of partners, as well as targeting or focusing on the most fruitful potential investments. So that's something we're really excited about, and we've thought a lot about at DFC and the creation of this department.
Thank you, Dia. Staying on partnerships and platforms, now this can be a very technical topic. So besides Googling the terms that came up today, what is your suggested approach for an institutional investor or even a fund manager looking to leverage risk mitigation tools? Where can they start? Dia, I'll hand over to you.
Yeah, I thought a lot about this because I think if you're and looking at it from a emerging fund manager, it can be overwhelming. Who do I approach? You know, you start to think about the timeline to develop these partnerships or relationships. So my thought or my recommendation would be from the fund manager's perspective or from the investee's perspective is it's really good to find one partner, one like-minded partner, potential investor, donor, foundation, whatever, that really understands your story or your thesis and be able to build or grow from there. And the reason I say that, talking about partnerships and platforms, bringing it back to that, so many of the investments that we have looked at and eventually invested in have been from our partners that may have found an investment very early stage and brought it to us. And because they were so supportive of the investment, even though it was very early stage, it opened the door. So it was more of that warm introduction that led to potential investment. So that would be my first piece of advice. And the second is to really create a unique value proposition for your fund or for your company. I think a lot of times, and I'm sure Jen and Paul have had this experience where you find a lot of the investment stories are very similar, and you actually have to dig deeper to see the nuances or the unique thesis or proposition that the fund or the company brings to the table. So just being sure to highlight that. And then from institutional investors, my advice would be find other investors, maybe similar to yourself, that have done investments in these geographies or markets before. And also don't hesitate to reach out to DFIs or other organizations. We get very excited about aligning with these institutional and private investors, and also kind of having that exchange and dialogue on potential opportunities. So it's just a matter of kind of increasing those connections to see where you could work together or partner, as we've mentioned.
Thank you for that, Dia. Gina, anything to add?
Yeah, I mean, I guess for just besides Googling, I guess I would make a plug for the Prosper Africa site. It's because we do have kind of on that site, prosperafrica.gov, all of the different, most of the tools from all the USG agencies that focus on trade and investment is in one spot. It's not going to answer every question you have, but it might be a good start for understanding, at least from the USG. Really good points that Dia makes on from the fund perspective, just spurred some thoughts that I had from the investor delegations that we've held. Those have been really valuable, for the investors, institutional investors, to hear from each other, because usually our delegations are made up of some investors that don't know the continent at all, some that have maybe dipped a toe in the continent and know a little bit, and some that are more familiar with the continent. The other thing I was going to say, and this seems obvious, but in my experience, it's, going to the very relevant conferences, and meeting folks there. And and to bring our delegations to some of those big conferences like Africa or Super Return. And you've got kind of a culmination of a lot of people in that space that that can offer some risk mitigation. But to Dia's point about how funds need to be able to tell their story. I think one of the things that we've done on our investor delegations is we've arranged for pitches from African-based funds to the institutional investors. And I think those have been really good experiences for them to better understand how to improve their pitches, right? To understand also to hear from U.S. institutional investors, what are they looking to hear? What do they care about? So those are one of the things that even just with our convenings, I think has been valuable in terms of both sides getting educated about, about what's out there and like how they can improve their approach. Because it is a long haul from when they first understand who to approach and and getting that story told and reaching a conclusion, the risk mitigation tool. So yeah, I would say the website and then just relevant industry events. I think that you are going to find, organizations like ours that have risk mitigation tools and for partners.
Thank you, Jenna. I think definitely being in the room with the people who are doing the work you want to be involved in is quite important. Paula?
Yeah, I guess from our side, very simply, we have offices across the continent where we either have people in the financial sector or represented by the country team. Anyone who's interested for a dialogue, we're happy to meet with them, in the relevant office. And, I like the way we approach it is to really look at these opportunities holistically, and that's a dialogue we're happy to go together with those prospecting, investing in these markets. So yeah, being able to provide direct assistance through the offices which we have across the continent, and then in addition, speaking to what has already been mentioned, being exposed to events where you have various actors there where they can exchange ideas and explore new solutions initiatives. IFC does co-host AFIS, the Africa Financial Summit, which brings in several actors from the continent, regulators, investors, and the like. And it's a really interesting space to look at what's next for the continent and what investors again are interested in to explore. And we also have the SME Finance Forum, which is very specific at looking at how we can promote financial inclusion to the SME sector. Again, you have several actors there where you can look at, okay, what's the innovative solution that's coming up and give them ideas of where they can participate. But, as mentioned, we're happy to provide, a description of our work and commence a discussion, and just reach out to anyone for offices.
Prepare for your LinkedIn inbox to be very busy after this session. That concludes our discussion today. And so I will be reading some of the questions in the interest of time that we can get to. The first question is for Jenna. What was the role of Prosper Africa in the issuance of the bond for affordable housing that the DFC guaranteed?
Thanks for that question, Catalina. Yeah, so we helped structure the bond and brought together the players, which included Bank of America from the U.S. institutional investor perspective, and help structure the bond. I saw your follow-on question. Did we facilitate U.S. government investment? Yes, that wasn't the only investment that we facilitated, but of course, when we see a transaction where we can bring together a tool from another U.S. government agency, we certainly view that as a win, and something we should take advantage of and collaborate with our agencies. But we did use some TA to help structure, and again brought Bank of America also to that transaction, which I think was very successful.
Thank you, Jenna. And this next question is for the panel, and I'll try and see if I can word it. There may be some countries that may be perceived as too risky for investors. What are you doing to reach the most fragile economies? And I think, Paula, you might have touched on this and in the innovation that you are looking at doing. And I think this is where data is important. But do you have anything to add to that?
Yeah, so in IFC, we're definitely giving a focus to fragile conflict-affected states. It's a key pillar in our strategy, and it aligns with our overall development thrust. And so the way we would approach that is, you have to, and it's been mentioned also, a holistic approach into strengthening the sector so that they become more viable for investors. So the work that we do includes improving the enabling environment, and this is never going to be a cookie cutter solution. We do a very in-depth diagnostic of what's needed in the country and provide, bespoke solutions both at sector level and at firm level. So examples like what we do on credit infrastructure, what we do on developing the capital markets, providing guidance on how to go about climate finance is one way of strengthening and improving in a way, the credit perception of a country by improving the framework for investments to come in, making things more predictable, having a credible framework around it. And alongside that, building private institutions so that then they can, and these are where private sector investments can go directly. But it's inevitable, especially for the more challenging markets, to build the framework for regulations and the enabling environment, because that's what creates the level playing field for investors to come into the market.
Thank you, Dia. And I will ask two questions. So they've been included on the chat as two questions, but I'll try and ask it in one. Do we see enough domestic African capital playing the catalytic / risk-seeking role in unlocking capital for impact? There's been more co-investments between international organizations rather than between international and local partners, so that Africans can learn and get experience in these innovative finance mechanisms. What are you doing to help local institutions to learn by including them in your projects? So I think this really talks to all the different types of partnerships that you've mentioned. I think from a government perspective, obviously they are the policymakers and they are typically involved in a lot of your engagements. But when we talk to institutional investors and fund managers, how do we involve them more? Dia, I don't know if you want to start.
Sure. So what I'd say is we prioritize projects. Again, it's about that additionality where there is inclusive capital and local investor involvement for a number of reasons. One, that's really the way to have sustainable growth and impact in a market, to develop a market, to support projects at scale. Additionally, most of our investment, our lending is in US dollars. So that's also a vehicle for us for local currency financing when we can get local capital providers involved in the market. And just let me give a couple examples. I know we're short on time on how we do that. Working with local banks to provide SME financing facilities. We also provide local currency guarantees where we engage banks to provide local currency financing to our clients. And that enables the client to develop a relationship with the bank to get financing independently after our loan has matured. Additionally, we like to work with fund managers that are able to also get local capital. And we hope we can catalyze that with our investment, because we find it plays a significant role in accountability and actually having people on the ground in the community looking at the investees in the portfolio. So we've seen that really successfully in one fund, how they've integrated or involved angel investors. So those are just a few examples. And that's definitely something we look at, is that we want to spur the local markets and not in any way kind of incur on the investments that they can make.
Thank you, Diane. Oh, sorry, Jen. I was going to ask you another question to wrap up the session. Around the timelines when it comes to funding, or maybe timelines when you come up with some of these solutions.
Oh, I don't know if any one of us wants to hazard on answering.
I know.
Later say you didn't stick to your timeline. I mean, timelines are so dependent on so many different things, right? And this goes to some of the comments that were made before, but sometimes they're very dependent on the readiness of the fund or the project itself, right? And how much they have. And so I don't want to hazard a timeline because that's very dependent. I know that's not a great answer, but I don't think there's any way for any one of us to give a solid answer on timelines. It's very dependent on a lot of factors. I did want to very briefly just on the back of the last question, I just mentioned that we've done a lot to work with local pension funds. And so I did want to mention that we've done a lot and we've been successful in getting US pension funds to co-invest alongside local pension funds. We view them absolutely, like Dia said, like having local partners is essential, especially for, in light of we said boots on the ground are very important for investors that don't have boots on the ground, like they get a lot of comfort from local investors. So we have worked a lot on partnering US institutional investors with local pension funds. The other thing that I saw happen last year at one of our delegations, we brought a delegation to South Africa around the pension fund conference. I forget what it's, GEPF, the Global Employee. And what I saw happen there was really interesting. That's a fantastic conference. And in a lot of the sessions, we had our US institutional investors raising their hands and contributing to the conference in a way I think that was very valuable for the local pension funds, because the pension funds California, New York, we're standing up and saying, this is how we're doing things when it comes to, incorporating sustainability into our operations and things. So you could see that there was a lot of really valuable exchanges there. So I just wanted to highlight, some of the work we've done with local pension funds.
Thank you so much, Jana. And that brings us to the close of our session. I would like to thank our panelists for their valuable insights. We truly appreciate your time. And to everyone who was able to join us today, just a reminder that this session will be made available to all those who have registered, as well as on Media Advisors and Standard Bank social media platform. And with that, I would like to thank you all and have a good day further.
Thank you
For having me.
Thank you.